Bob, you've been bullish through a lot of this year on this bond market, looking for this to rally. It has done over the last month. What do you think we're going back to right now, Bob?
I think you've got to start pricing in a lot of rate cuts next year. And the market is always tentative about changes in cycles, whether they're entering a hiking cycle or a cutting cycle. And the reality is, once they start cutting rates, they do a heck of a lot. We've looked over the last 40+ years, the last 7 hiking cycles, and we've looked at the return of the bond market the 2 years following the last rate hike. And bonds outperform cash by 13%. And the average rate cut is about 500 basis points. And if you go to the couple periods where you didn't get that, the 95, 97 period, that sort of soft landing, you got 175 basis points in rate cuts. And if you go to the pandemic, rates had only gotten up to 2 3/8%. So you got 2 3/8% in rate cuts. That still averages to about 200. So once they start going, we expect a lot of rate cuts, and we expect excellent bond market performance going forward.
But when you say a lot, do you mean 200?
I think at a minimum. I think that they get down to the 2.5% to 3% range. Take zero off the table. Every conversation I have with clients, everyone wants to know, well, if they start cutting rates, does that bring us down to the zero lower bound? No, it doesn't. We're well beyond that. That was the last cycle, and hopefully that generational episode doesn't occur again for a few more generations. Something more reasonable is to take half of the rate hikes back. Think about 2.5%, 3%.